Welcome back to the Deep Dive. Today we are stripping away the software layer entirely. We aren't talking about the chatbot that writes your emails or the AI agent booking your flights.
No, we're going down to the physical layer.
Exactly. We are going down to the concrete, the copper, and the cooling fluid. We are talking about the AI factory.
It's the physical reality that everyone seems to ignore until, it breaks or it isn't there. It's the place where these digital brains actually live.
Right. Because everyone is absolutely obsessed with the chips, NVIDIA, obviously, and the models, ChatGPT, Gemini, you name it. But almost nobody talks about the physical infrastructure required to keep those things from literally melting down.
Which is, I would argue, becoming a bigger bottleneck than the silicon itself. You can buy a chip today if you have the cash.
Right.
But good luck finding a place to plug it in that has enough power.
And that's where today's company comes in.
Yeah.
Right at the center of this infrastructure's form is Applied Digital Corporation, ticker APLD. If you're looking at the charts today, Saturday, January 17th, 2026, the stock is sitting around $37.40. It's up over 6% in the last session. And get this, up 56% just this year.
And we're, 2.5 weeks into January?
Barely. It's an incredible run.
It has been a completely parabolic start to the year, a classic momentum trade, really. But it's fueled by a perfect storm of news that's just hit in the last 10 days or so.
And this is a massive but that's going to loom over this entire deep dive. While the stock is just ripping higher, there's a war happening right underneath the surface.
Absolute battle, yeah.
You have 30% of the float shorted. 30%. These are people betting on a total and complete crash.
Then you have the CEO who just sold $6 million worth of his own shares right into this rally.
Which never looks great. And on top of all that, you have a debt wall. A wall of debt looming in 2030 that looks absolutely terrifying to anyone who can read a balance sheet.
It's one of the most polarized setups I've ever seen. I mean, I rarely see a stock where the bulls are calling for a 10-bagger, a 10x return, and the bears are screaming it's going to zero. And, both sides have pretty valid math to back up their arguments.
So that is our mission today. We need to figure out, is Applied Digital the next great utility company of the AI age? A new kind of monopoly? Or is this just a leverage-fueled house of cards waiting for a strong breeze to knock it all over?
To answer that, we're going to have to pull apart the business model, the actual physics of their cooling technology, and a very complex spin-off that's about to split this company in two.
All right, let's get into it.
Chapters 1 to 3, Business, Management, and Financials.
Chapter 1, Business Understanding.
Okay, so this past week has just been chaotic for this stock.
Yeah, let's just unpack the last, 72 hours? Because if you're just tuning in, it honestly feels like a year's worth of news drops. It's New Year.
It really was a trifecta of catalysts. You had the earnings report on January 7th, then a big leadership shuffle on the 15th, and then that insider sale hit the tape on the 16th.
Okay, let's start with the earnings. That's what really kicked off this rally.
That was the spark for sure.
Revenue up 250% year over year to $126.6 million. That is a huge number. But is it just, base effects? Were they starting from basically zero?
That's the right question. And they weren't starting from zero, but in terms of this new dedicated AI hosting revenue, they were starting from a very low base. This was the proof of life quarter.
Proof of life. I like that. What do you mean?
Well, for the last, call it 2 years, Applied Digital has essentially been selling a story. They've been selling a backlog, basically a spreadsheet full of promises and contracts.
Right, future revenue.
Future revenue. This quarter, Q2, was the one where they showed the market that the checks are actually clearing. The buildings aren't just empty shells anymore. They are energizing them, and tenants are paying rent.
So the factory is officially running. Okay. Then, fast forward to the 15th, just a couple of days ago, Jason Zhang gets appointed president. Who is he and why does that matter?
So Zhang is interesting. He's one of the co-founders, but his background is what's really key here. He comes from MSD Capital.
MSD Capital.
Yeah.
That's Michael Dell's family office, right?
That's the one.
I see that Dell connection mentioned in the forums and on Twitter constantly. Is that actually material? Is it a real advantage or is it just, fancy name dropping?
Oh, it's absolutely material. Think about it. When you're building these massive, complex data centers, your supply chain is everything. You need switchgear, you need transformers, servers, storage.
The stuff that's been impossible to get for the last 2 years.
Exactly. The rest of the world is waiting 18 months for critical gear. Having a direct line, a real relationship within the Dell ecosystem is a massive, massive advantage. So Zhang taking the president role signals a shift.
A shift from what to what?
From deal-making mode to industrial execution mode. It's less about signing new contracts and more about actually building the things they've already sold.
Less shaking hands, more pouring concrete.
You got it. That's the signal the board is sending.
Okay, that makes sense. But before we get too excited about the future, we have to address the elephant in the room, the company's past. A lot of our listeners are going to remember this company as Applied Blockchain.
They will. They were a crypto miner. And that stigma definitely sticks.
It really does. It's easy to look at that and feel like it's a pivot of convenience. Like, oh, Bitcoin is down. Okay, quick, let's just say we do AI now.
That's the cynical view, and honestly, it's a fair criticism to have in your mind, but I think you have to look past the name and at the physics of what they actually built.
The physics.
Yeah, they were building facilities designed for high-density, power-intensive computing. Crypto mining is just one application of that. What they've done is move from a commodity-linked business where your revenue depends entirely on the price of Bitcoin.
Which is wildly volatile.
Insanely volatile. And they've moved to a utility model. It's a fundamental shift in the business.
Okay, so break that down for us. What are they actually selling now? What does this utility model look like?
This is probably the most important thing to understand. You have to distinguish between their two business segments because they are totally different animals.
Two segments, okay.
First, you have HPC hosting. HPC stands for high performance computing. This is basically their landlord business.
The landlord business, so they own the building.
They own the building. They bring in the massive power lines from the utility. We're talking high voltage transmission. And they install these incredibly complex liquid cooling loops. But, and this is the key, the tenant brings their own expensive servers.
Oh, so the tenant is the one buying the $100,000 NVIDIA GPUs.
Correct. The hyperscaler or the cloud provider, someone like CoreWeave, buys the chips. So if those chips break or if NVIDIA releases a new chip next year that makes them obsolete, that is the tenant's problem, not Applied Digital's.
Then APLD just collects rent.
They just collect rent on the space, the power, and the cooling. It's like a triple net lease, but for digital brains. Long-term contracts, 10, 15 years. Very stable.
Okay, that sounds like the safe, boring, predictable part of the business.
Yeah.
What's the other segment?
The other segment is cloud services. This is their GPU as a service offering.
So in this model, they buy the chips.
In this model, they buy the chips, they go out and buy the NVIDIA H100s and Blackwells, they own the silicon, then they rent out that computing power to smaller customers by the hour or by the month.
That sounds significantly riskier.
It is. It's way more capital intensive. You have to front all that money for the GPUs, and you hold all the technology risk. If NVIDIA releases the Rubin chip next year and the value of your H100 gets cut in half, Applied Digital eats that massive depreciation charge.
Which would explain why they want to get rid of it. We'll get into the spinoff in more detail later, but the whole strategy is to carve that risky piece out.
Right. Exactly. They want to separate the volatile tech play from the stable utility play. But I want to go back to the landlord side for just a second. In your notes, you asked about the physics of the moat.
Yeah. What's stopping Amazon or Google or Microsoft from just building their own data centers? Why do they need to lease from a small company like Applied Digital?
It all comes down to one word: density.
Power density.
Power density, exactly. A traditional data center, the kind that holds, your bank records or streams Netflix movies, runs at about 10 to 15 kilowatts per rack.
And it's cooled by what, just big air conditioners?
Pretty much. Fans blowing cold air across the servers. It's a system that's worked for decades. But AI is different.
Because the chips run hotter.
Much, much hotter. AI training clusters, especially those packed with NVIDIA Blackwells, are incredibly dense. We are talking about needing power densities of over 100 kilowatts per rack.
100 kilowatts. So what is that like? Running 100 hair dryers inside a single phone booth.
That's a pretty good analogy, yeah. If you tried to cool that with air, you'd need a hurricane-force wind blowing through the building. It just doesn't work. It's physically impossible.
So what's the solution?
You need liquid-to-chip cooling. You have to run pipes of specialized fluid directly over the silicon itself to pull the heat away. Applied Digital's new campuses, the ones in Ellendale and Polaris, North Dakota, were purpose-built from the ground up for this.
So they're not building so much as they are massive industrial-scale radiators?
That's a great way to think about it. They're specifically designed industrial heat exchangers. And the key is that most of the world's existing data centers cannot be retrofitted for this. The floors aren't strong enough to hold the heavy fluid tanks. The plumbing isn't there. The power infrastructure is insufficient.
Okay, so the building itself is the moat. But why North Dakota?
I've been Ellendale.
It is remote.
It's not for the scenery, that's for sure. It's for the stranded power.
Stranded power. Define that for us.
The U.S. electrical grid is incredibly congested. If you go to a place like Loudoun County, Virginia, which is Data Center Alley, or Silicon Valley in California, there's a 5-year waiting list just to get new high-voltage power hookups. The grid is full.
There's no more juice to be had.
Right. But North Dakota has the opposite problem. They have massive wind generation capacity, but they don't have enough transmission lines to send all that power to big cities like Chicago or Minneapolis. So the power is effectively stranded there.
Meaning it's cheap and, more importantly, it's available right now.
It's cheap, clean, and available. So Applied Digital showed up and basically said, we'll be your new customer, we'll take all of it. And that right there is their true moat. The bottleneck in AI isn't the chips anymore. You can buy chips if you have cash. The bottleneck is the plug. APLD secured the plug.
And that plug has generated a $16 billion backlog. Is that number real?
That's the headline number. $16 billion in contracted, legally binding revenue over the next 10 to 15 years. That's what turns this from a speculative construction project into a predictable annuity.
Chapter 2, Management Evaluation.
So we've established the business is basically renting out these high-tech refrigerators in the frozen north.
A great summary. Now let's talk about the people running the show. The jockey, as they say. Wes Cummins, the CEO.
Wes is an interesting study. He's not a tech guy. He's not an engineer who came up through Intel or Cisco. He ran a hedge fund, 272 Capital.
So he's a finance guy, first and foremost. He's looking at the world through a spreadsheet, not through a circuit board.
Exactly. And you can see that in his interviews. He talks constantly about ROIC, return on invested capital. He doesn't seem interested in just building the biggest empire for the sake of ego. He wants to know if every single dollar spent on concrete and copper is going to yield a high return for shareholders.
Okay, a focus on returns. That's good. Which brings us to the insider sale. Friday, January 16th, the stock is rallying hard, and Wes Cummins sells 165,000 shares. Pockets about $6 million.
Yeah, optically it never looks good. The message boards and Twitter just light up with people yelling, he knows the top is in, he's getting out.
Well, Izzy, it's a fair question. If you genuinely believed your stock was going to $100 a share, why would you sell at 36?
We have to look at the context and the scale. It's just basic portfolio management. Even after selling that $6 million worth of stock, he still owns over 4 million shares directly.
4 million shares.
And he controls another 17 million indirectly through his fund. His net worth is overwhelmingly tied to this company's success.
So he is still massively, massively long the stock.
He has generational wealth tied up in APLD. Taking $6 million off the table after a 56% run-up in 2 weeks is, well, it's rational. It's just prudent risk management for his personal finances. I wouldn't read it as a lack of faith in the company's future at all.
Fair enough. Let's pivot to their capital discipline, which you mentioned as a key strength. You said they avoided dilution. How?
This is something that's really rare for a small cap growth stock, especially one that came from the crypto world.
Right. Usually they just print new shares like confetti.
They do. It's the death spiral financing. They dilute existing shareholders to nothing to fund operations. But APLD didn't do that. When the stock was trading at $3 or $5 last year, they flat out refused to issue equity at those low prices.
So how did they fund the construction?
They got creative. They used project-level debt.
Meaning the debt is secured by a specific building, not by the entire parent company.
Exactly. So if one project goes bad, it doesn't sink the whole ship. And then they did a big deal for preferred equity with Macquarie Asset Management, a huge, sophisticated infrastructure investor. They've been incredibly protective of their share count. They treat their equity like it's gold, not like it's currency to be printed.
That's definitely reassuring for a shareholder. But respecting the equity is one thing. Being able to actually pay the bills is a whole other story. Chapter 3, Financial Health.
And this is where the rubber really meets the road.
Yeah, I'm looking at the latest income statement. Revenue, $126 million. Great. We'd love to see that growth. But then my eyes go down a few lines and I see a GAAP net loss of $31.2 million. They're losing money.
This is one of those areas where you have to put on your forensic accountant hat, because in the data center world, GAAP net income is almost a lie. It's very misleading.
Why is that?
One word: depreciation. When you build a billion-dollar facility, accounting rules say you have to expense a portion of that building's cost every single year on your income statement. It shows up as this massive cost on the P&L.
But, and this is the important part, You aren't actually writing a check for that depreciation cost.
Exactly. It is a non-cash expense. It's an accounting fiction.
So their cash balance isn't actually dropping by $31 million every quarter.
Not at all. That's why, for this industry, we have to look at a metric like adjusted EBITDA. It strips out those non-cash charges, and their adjusted EBITDA was positive $20.2 million.
Okay, so operationally, they're cash flow positive.
Right.
The rent checks coming in are more than enough to cover the electricity, the employees, all the actual operating costs.
With plenty of room to spare, they aren't bleeding cash on day-to-day operations.
Okay, that's the good news.
Yeah.
But now let's turn to the balance sheet, because this is the wall of debt everyone talks about.
It is a monster. No way to sugarcoat it. Their total debt is around $2.61 billion. But the really scary number is the $2.35 billion in senior secured notes.
And when are those due?
2030.
Okay, so they have some time. But what's the interest rate on that debt?
9.25%.
Ouch. That's practically credit card territory for a corporate bond.
It's high yield. It's junk status debt. It means they're paying roughly $217 million a year just in interest payments.
Wait a minute, let's do the math on that. We just said their quarterly revenue is about $126 million, so let's annualize that. You get just over $500 million a year in revenue, and $217 million of that is going straight out the door just to service the debt, nearly half their revenue.
And that right there is the solvency race. That is the entire investment thesis for this company, bull and bear, boiled down into one simple race.
Okay, visualize this race for us. What does it look like?
Imagine a chart. You have a flat red line. That's the $217 million annual interest expense. It's a fixed cost. Then you have a blue line, which is their revenue, swooping upward as the new campuses come online and start generating rent.
And right now, the blue line, in terms of the cash flow available to pay debt, is below the red line.
It's below the red line. It has to cross it, and it has to cross it fast.
What happens if they stumble? What if there's a huge blizzard in North Dakota and construction gets delayed for 4 months?
Then the math breaks. It's that simple.
Ludo.
Now, they do have a runway. The principal payments on that big bond, the amortization, that doesn't start until December 2027. So they have roughly 2 years, maybe a little more, to get their full 400 megawatts of contracted capacity online and generating cash.
So they are borrowing against a future that has to arrive on a very specific schedule. If the buildings get built on time and the tenants move in as planned, the revenue will swamp the debt and the equity holders get very rich.
Correct. The operating leverage here is massive. Once that interest payment is covered, almost every additional dollar of revenue flows straight to the bottom line.
But if they miss that deadline,
If they miss the deadline and can't cover the interest, it's a restructuring event. The bondholders take the keys to the company. The equity is likely worthless.
high stakes.
To the highest stakes imaginable.
So how is the market pricing this binary outcome? What does the valuation look like?
Well, on a trailing basis, it's trading at about 21 times current sales. That's very rich, very expensive.
It is.
But if you believe the $16 billion backlog will convert to revenue over the next decade, it's only trading at about 10 times future sales. So you're paying a huge growth premium. You're paying for the belief that Wes Cummins and his team can win this race against the clock.
We're going to take a quick break here. When we come back, we're going to talk about the army of short sellers who are betting everything on a crash and the complex ownership structure, specifically this spin-off that might just be the company's escape hatch. You know, digging into balance sheets like APLDs can be absolutely exhausting. If you want to skip the spreadsheet headaches and get straight to the insights, you really need to check out stockanalytics.ai.
Like and subscribe to Stock Analytics AI.
Want institutional-grade stock research without the institutional price tag? Check out stockanalytics.ai. For just $10 a month, you get full access to our deep dive video library covering over 500 S&P 500 and NASDAQ 100 stocks, each with full source citations you can verify.
Can't find the stock you're looking for? Request analysis on ANY ticker and we'll deliver it within 24 hours.
Upgrade to Pro for $20 a month and unlock our SEC Risk Scanner, which detects red flags in company filings before they hit the headlines, plus our Portfolio Diversification Analyzer to optimize your holdings.
Start your 7-day free trial today at stockanalytics.ai. Make smarter investment decisions with research you can trust.
Part 2, Chapters 4 to 7, Market Sentiment, Ownership, Risk, and Final Conclusion. Chapter 4, Market Sentiment.
All right, we are back. Before the break, we outlined this high-stakes race against the debt wall.
And now let's talk about the spectators who have crowded into the stands specifically to bet on a crash.
The short sellers. This is, without a doubt, one of the most hated stocks on Wall Street right now. The latest data shows that between 30 and 32% of the entire float is sold short.
Okay, for the listener who doesn't watch the ticker tape all day, put that number in perspective. Is 30% normal?
Not at all. A normal short interest for a stock is maybe under 5%. 10% is considered high. 30% is a full-blown battlefield. It means for every 3 shares that are available to trade, 1 has been borrowed and sold by someone who is betting the price will drop.
So what is their thesis? What are they seeing that the bulls aren't? Is it just the debt?
It's a combination of things. It's the debt, absolutely. It's also the customer concentration, which we'll get into. And it's the raw execution risk. They are betting that building these incredibly high-tech facilities in the brutal winters of North Dakota is way harder than management is letting on. They're essentially betting on a delay.
But having a short interest that high can backfire spectacularly. We saw this with GameStop. We saw it with Tesla. The dreaded short squeeze.
It creates what's known as a coiled spring. When you have 30% of the shares shorted, if any good news drops, like that earnings beat last week, the shorts all rush for the exit door at the exact same time. They have to buy stock in the open market to close out their losing positions.
Which, of course, drives the price up even further, forcing more shorts to buy and cover their positions. A feedback loop.
It's a violent feedback loop. The days to cover metric is around 1.4 right now. That means, given the average daily trading volume, it would take the shorts a day and a half of buying every single share that traded just to get out of their positions. That's what creates these insane, violent upside moves.
It certainly explains the 56% move this year, but the sentiment isn't just about this tug of war. There's been a more subtle shift happening in the quality of the investor base.
The institutional re-rating. Yes, this is a crucial point. For a long time, APLD was viewed by big money as a scrappy, speculative, post-crypto startup, basically junk quality. But recently, they announced they signed a $5 billion lease with an unnamed investment-grade hyperscaler.
And we still don't officially know who it is.
So rumors are all over the place. Microsoft, Oracle, maybe Google. But honestly, the specific name matters less than those 2 words, investment grade.
Why does the credit rating of the tenant matter so much to the landlord, to APLD?
Because you can take that lease to a bank and borrow against it at much cheaper rates. If your tenant is a risky startup, a bank might charge you 12% interest to finance construction. But if your tenant is Microsoft with its AAA credit rating, the bank will charge you 6%. It directly lowers APLD's cost of capital.
So it's a stamp of approval. It's a signal to the big conservative funds like Vanguard and BlackRock that says it's safe to come in the water now. The adults are here. Chapter 5. Ownership structure.
And speaking of Vanguard, who actually owns this company?
Let's look at the cap table.
So you have the usual suspects, the big passive index funds. Vanguard has about 6.2%. BlackRock has about 6.5%. They own a piece of everything.
Right.
But the one I found most interesting was Hood River Capital Management. They own about 7.4%.
Hood River. I have to admit, I don't know them.
They're specialists, small-cap growth experts. They are active managers. It means that people who actually do the deep dive homework, not just passive algorithms buying an index, are buying the stock in significant size.
That's a vote of confidence. And then the insiders still own a big chunk.
About 20%.
Okay.
And when you add all that up, the insiders, the passive funds, and these sticky active funds, it creates what's called a low float. There just aren't that many shares left available for day-to-day trading.
Which means the stock can move very fast on relatively small volume, both up and down.
Exactly. It adds to the volatility.
Okay, now we have to talk about the spinoff. This is probably the most complex part of the entire thesis. They're literally splitting the company in 2.
The Chronoscale transaction. This is a very clever piece of financial engineering. They are taking that cloud services business, the risky GPU rental part we talked about, and merging it with a publicly traded company called Exobionics, ticker EKSO.
Wait, Exobionics, the company that makes medical exoskeletons. That sounds completely random.
It is random. It's what's known as a reverse merger vehicle. It's basically just a regulatory shortcut to get the Chronoscale business its own public stock listing very quickly without a traditional IPO.
Okay, so walk me through the mechanics here. Let's say I'm a shareholder. I own 100 shares of APLD today. What happens to me after this deal closes?
So you keep your 100 shares of APLD. That company becomes what's called RemainCo. It strips out all the GPUs and the risk associated with them, and it just keeps the data centers, the power contracts, and the cooling infrastructure.
So APLD becomes a pure-play infrastructure stock. You can think of it like a real estate investment trust, a REIT.
That's the goal. Stable, boring, predictable. Hopefully one day it will pay a dividend.
And what else will we get?
In addition to your APLD shares, you will receive shares in the new company, Chronoscale. This will be the high-growth, high-risk AI tech stock that owns all the H100s and competes directly with companies like CoreWeave.
So why do this? Why go through all this trouble instead of just keeping it all under one roof?
It's all about valuation clarity. Right now, the market is confused about how to value APLD. Are you a stable utility that should trade at, say, 10 times EBITDA? Or are you a high-growth tech company that should trade at 30 times sales? The valuations are wildly different.
So by splitting them, they force the market to value the parts separately. It's a classic sum of the parts argument.
Exactly. And even more importantly, it quarantines the risk. It builds a firewall. If NVIDIA's chips suddenly become obsolete, that's Chronoscale's problem. APLD, the landlord, is insulated from that technology risk. They still get paid their rent regardless.
Chapter 6. Risk Assessment.
So we've painted a pretty optimistic picture of big backlogs and clever financial engineering.
We have. But now we need to put on the black hat and look at the dark side. What keeps you up at night with a stock like APLD?
Customer concentration has to be number one on the list. Their entire $16 billion backlog relies very, very heavily on just two main players, CoreWeave and that unnamed hyperscaler.
And CoreWeave is the big AI cloud startup that's been on a tear.
They're huge. They're backed by NVIDIA, but they are still a private startup. If CoreWeave were to stumble for some reason, or more broadly, if the entire AI capital expenditure cycle suddenly freezes because companies realize ChatGPT isn't as profitable as they hoped, Applied Digital has a massive problem.
Because these buildings they're constructing are completely bespoke.
They are. You can't just turn a liquid-cooled AI factory into a self-storage unit for furniture. If your main tenant leaves, that billion-dollar building becomes a stranded asset. It's worthless.
Okay, that's a big risk. What about the execution risk we touched on? The weather factor?
It's very real. A 6-month construction delay in North Dakota isn't just an inconvenience. It could be catastrophic because of that debt service clock that's always ticking. They need that revenue to hit the bank account before the massive interest payment leaves it. They're operating with very, very little slack in their timeline.
And then there's the refinancing wall.
The 2030 notes. We get to 2030, and that $2.35 billion comes due. If we're in a high interest rate environment then, or if Applied Digital hasn't managed to improve its credit rating from junk to investment grade, they won't be able to refinance that debt at an affordable rate.
So they have to grow up fast.
Yeah.
They need to transform themselves into a blue-chip quality borrower in just about 4 years.
That is the ultimate deadline. That's the final boss battle.
And lastly, the risk that's always present. Valuation.
The price-to-book ratio is around 7 times. That is high for an infrastructure company. It means the market is pricing in near-perfect execution. If they miss a quarterly earnings target, or if they have to lower their guidance because of a construction delay, this stock won't just dip, it will plunge. There is almost no margin of safety baked into the stock price at $37.
Chapter 7. Conclusion.
All right, so we've looked at the factory, the physics, the debt, the spinoff, and all the risks.
Time to bring it all home. After this deep dive, is Applied Digital a buy?
Look, the first thing to say is this is not a traditional Warren Buffett value stock. A classic value investor would look at that balance sheet, see the debt, and run away screaming.
So what is it then? How do you classify it?
It's a special situation. It's a workout. It's a high-risk, high-reward play on a specific set of future events unfolding correctly.
Okay, give me the bull case in one simple sentence.
Power is the ultimate scarcity in the AI revolution, and APLD owns the railroad tracks, the power, the land, and the cooling that the entire AI gold rush must run on.
And the bear case, just as concisely.
The leverage is absolutely terrifying, and it's a race against the clock where one single slip-up on construction could trigger a fatal liquidity crisis.
It really feels like a binary outcome. There's not a lot of middle ground here.
There isn't. I think this stock is either going to $100 or it's going to $5.
Here's my final thought for you, the listener, to mull over. After this Chronoscale spinoff happens, APLD, the remaining company, becomes a boring power and real estate company. And in the middle of the gold rush, boring is beautiful.
Interesting.
Everyone out there is trying to pick the winning gold miners Is it going to be OpenAI? Is it Anthropic? Is it Google? That's the risky bet that Chronoscale is making. But APLD is just selling the land that the mine sits on.
And the landlord gets paid their rent, whether the miners strike gold or just find a bunch of dirt. Exactly. The market structure suggests that owning the land might be the much safer bet in the long run, even with that massive mortgage on it. That's a wrap on our deep dive into applied digital. If you want to dig deeper into the numbers yourself, and you absolutely should, make sure to like and subscribe to Stock Analytics AI for more deep dives.
And a quick reminder, this analysis was generated using AI research tools and does not constitute financial advice. Always do your own due diligence.
Thanks for listening, and we will see you on the next deep dive.